Hey there. Welcome to my finance channel. Today we're diving into a topic that affects everyone, whether you're an active investor or just getting started. And that topic is inflation. What is inflation? Where does it come from? How does it impact your money? And what can you do to protect yourself? This is a crucial subject. Inflation works slowly but surely. Inflation is the rise in the general price level of goods and services in an economy over time. In simple terms, your money buys you less than it used to. For example, if a cup of coffee in the US cost $3 a year ago and today it costs $3.30, that's a 10% price increase. If this kind of rise applies broadly across most goods and services, we call it inflation. Inflation erodes the purchasing power of a currency, whether it's the dollar, euro, or yen. How we measure inflation. Inflation is measured using specific indicators, the most well-known being the CPI, Consumer Price Index. CPI tracks price changes in a basket of goods, a set of products and services commonly purchased by households. This basket typically includes items like food, housing, transportation, energy, healthcare, education, and recreation. The value of this basket is monitored monthly and compared year over year. Other indicators include HICP, used in the Eurozone, aligned with Eurostat standards. Core inflation excludes the most volatile categories like food and energy. What are the causes of inflation? Inflation can be triggered by different mechanisms. Here are the key drivers. 1. Demand pull inflation, when demand exceeds supply. Example: after COVID-19, many governments injected billions of dollars into their economies, boosting consumption faster than companies could rebuild production. 2. Cost push inflation, when production costs rise, such as raw materials, energy, or labor. Example: after the Russian invasion of Ukraine, energy prices in Europe skyrocketed, pushing up the cost of many goods. 3. Monetary inflation, when central banks print too much money. Example: if the Federal Reserve expands the money supply without a matching increase in real economic output, it can lead to inflation. Is inflation always bad? Not necessarily. Moderate inflation, around 2 to 3% per year, is generally considered healthy. It encourages spending and investment instead of hoarding cash. That's why, for example, the US Federal Reserve targets a 2% inflation rate. The real problem is high or unstable inflation, like what we've seen in Turkey, Venezuela, or Argentina, where prices can rise by dozens or even hundreds of percent annually. That kind of inflation destroys savings and destabilizes the economy. How inflation affects your money. Let's say you have $10,000 sitting in a savings account with zero interest. If inflation is 8% annually, then after 12 months, your money has the same nominal value, $10,000. But in real terms, it's worth only $9,200. You can buy less with the same amount of cash. That's called the hidden inflation tax. Over time, if you don't invest, inflation can significantly erode your capital's value. So how can you protect yourself? Inflation-indexed bonds. A good example is U.S. Treasury, inflation-protected securities, which are government bonds whose value rises along with inflation as measured by the Consumer Price Index (CPI). These types of financial instruments help preserve your capital in real terms, because both the principal and the interest payments are adjusted to reflect current inflation. They're especially useful during periods of unexpected or rapidly rising inflation. Stocks of publicly traded companies. Over the long term, stocks can serve as an effective hedge against inflation, as many companies are able to pass increased costs onto consumers through higher prices. Moreover, well-managed businesses across various sectors can grow profits even during inflationary periods. Diversifying your stock portfolio across different industries helps balance risk and potential returns, improving your resilience to economic shifts. Real estate. Investing in real estate is a classic strategy to protect wealth from inflation. Property values, including residential, commercial, and rental real estate, tend to rise in line with general price levels in the economy. In addition, rental income can be regularly adjusted to match market conditions, helping you maintain the purchasing power of your cash flow. Gold and other precious metals. Gold has long been considered a safe haven in times of economic uncertainty and high inflation. While it doesn't generate passive income like dividends from stocks, its value often rises when confidence in fiat currency declines. Investing in precious metals such as gold, silver, or platinum can diversify your portfolio and reduce overall volatility. Exchange-traded funds and sector-based funds. Exchange-traded funds provide exposure to various asset classes and economic sectors, such as commodities, energy, technology, or dividend-paying companies. They allow investors to build a diversified, inflation-resistant portfolio in a cost-effective way. These funds offer the opportunity to benefit from sectors that typically perform well during inflationary cycles. Short-term bonds. Short-term bonds are less sensitive to interest rate fluctuations, which tend to increase during inflationary periods. This makes them less risky than long-term bonds and a more stable component of an investment portfolio. Their frequent maturity allows investors to adapt more quickly to changing market conditions. Inflation is a natural economic phenomenon, but it can have a huge impact on your finances. Holding cash, you're losing value. Investing wisely, you're protecting or even growing your wealth. Remember, inflation works slowly but persistently. Smart investors don't ignore it. They learn to work with it. Let me know in the comments how you're protecting your money from inflation. If you found this video helpful, give it a thumbs up and subscribe to the channel.